So, good morning, active traders, and welcome to our latest episode of Trading Week Ahead. I'm Ken Calhoun, your host, UCLA graduate, former corporate statistician for Ford Motor Company, Money Show speaker, award-winning #1 ranked author in Stocks and Commodities magazine. And I certainly appreciate, thank you for voting me #1 and #2 last year author in the world. Please vote for me again this year if you're a Stocks and Commodities subscriber. And if you're not, why aren't you a subscriber? Subscribe to Stocks and Commodities magazine. I give you monthly, every single month. I've got my Trading on Momentum column for years now, based on recent real money trade wins and losses and everything in between to try and keep people on the right side of your trades so you can potentially make bigger winners more often. That's my mission, to help you make money. You don't want to just be out there going, buy, buy, buy. No, you'll just get in trouble and you'll just lose money. Don't do that. Learn how to trade professionally. As always, all information is for educational use only, not making advice about what to buy, sell, or hold. That's me having a great time. So what's up with this wacky market? We're selling down. Market has 4 economic headwinds. Obviously, we've got not only the China trade war fears, but we've got IPO hell out there. IPOs have been failing miserably, like the PLTO or PLOT, whatever one from yesterday or day before. We've got recessionary fears. We've got trouble in Europe. We've got Saudi oil production got blown up or cut down in half. We got all kinds of reasons to sell the market and not a lot of reasons to buy. And for that reason, I'm a bear. Kicking Wall Street's ass. Let's take a look at what's going on. Plays for potential pivots include instruments like TQQQ, my longtime favorite TVIX, and much more. Big picture, if you are going to trade stocks in our current market, be sure that you're focused on ones like I mentioned here for you guys earlier, Hovnanian and HOV. If you do trade, I'm not opposed to not trading stocks under $10. I do that on occasion, but for swing trades only, like my successful Pier 1 imports trade where I bought 5, and I alerted my members to go long at 522, and I sold 915 or so. I haven't touched it since. Kind of sketchy up here. I might buy it if it drops back down to 5 and bounces, but I'm not going to touch it again. But look at the volatility and the directional consistency of this chart, right? I bought 520 and it ran all the way up to 13. Now I usually sell too soon, but I think there's no such thing. In our volatile markets, you might want to buy the dip and sell the rip, or buy the breakout and sell the fake out as soon as it starts to roll over near whole number. Be sure to use whole number resistance triggers, as I've taught for decades now. And if you are trading small caps, they should go, a little something like this, right? Like go, 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 like Speed Racer. Go Speed Racer, dun, 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 dun. Went from 4 to 7. When trading volatile markets, you got to trade a lot of different instruments and figure out where the next play is. Now, if we take a quick look at our banking and other directional sectors, you can see banking's been selling. Typically, precursors to sell-offs in the stock market are weakness in small caps and finance and banking, right? And small caps, as small caps go, they're kind of a lead indicator, and finance and banking is a confirming technical indicator for directional play. So if you're looking at sector rotation and you're looking for where things are headed, one quick tip is you always want to keep eyes on the VIX. If you're a day trader, you also always keep your eye on the ARMS index, the trend. The trend and the VIX are absolutely critical to navigating our current markets. I teach how to do that exclusively in my live room at tradingtheopen.com. So make sure that you're a member if you're not yet a member. I wanted to take a second to say thanks to all of you for making this the #1 ongoing webinar series in the entire trading industry. You guys are rock stars, and thanks for being here. So pay attention to the VIX. The higher the VIX goes, the more down the market will likely go, right? So with increasing volatility, we've got a bullish engulfing in the VIX. A lot of institutional folks I know, big money professional traders, are extremely long the VIX, whether you're buying VIX calls as options traders or as me trading the underlying ETFs, ETNs like TVIX, VXX, and UVXY. But anyway, now's a really smart time to be on top of the markets intelligently with a trading plan. You've got to have a trading plan that helps you make sense of these markets, because it's a very headline, we're just a tweet away or headline away from either a big rip up in the markets or a big sell off, right? That's why I was joking with the Fidelity trading desk guy yesterday. I was talking about trailing stops and instruments like TVIX. I was up nicely. I trailed the stop. I closed out the trade on the drop and I rebought into the close. I did that live in front of everybody with the free session I did yesterday. But anyway, looking for capitalizing on volatility in these kind of instruments is what I'm an expert at. I'm the world's top expert that I know for intraday trading the inverse ETFs. Show me anybody that can prove they've traded as profitably or as often as I have with the winning setups that I've got in my various ETFs. Nobody can touch me. I'm the world's best. And what I want you to do is learn, even if you don't join my services, I'm still rich. I don't care if you join or not. But if you do choose to wisely join, or even if you don't, pay attention. My educational tips, I got about 10 minutes left here, is pay attention to and keep track of things like your VIX instruments, sector rotation, getting back to sectors. Starting off with VIX, I want you to be like I am. I'm obsessed with volatility. The two best people in the world to learn volatility from are Tom Sosnoff and John Bollinger, right? Those are the two top volatility experts I know. And anyway, I like using the VIX to help navigate directional bias for ETFs as well as the broad market. So keep an eye on the VIX. Obsess with the VIX is my tip of the week. Tip of the rest of the year is pay really careful attention to the VIX, especially if we break north. We closed up near 17. I was shocked to see the VIX holding down under 15 this week, a couple of weeks ago, as were most Wall Street pros. We're finally starting to climb up out of the muck. Next stop, VIX 30, right? Wouldn't be out of the picture at all. So I want to capitalize on that. Second, what you want to do is keep an eye on your sector charts and see sector rotation or industry groups, who's leading the way. Well, it's not pharmaceuticals. Gold has been divergent down the last several sessions, but look for a potential resumption of uptrend in gold if the market continues to sell off. That'll be a defensive hedge. Our Dow Jones Industrial, the Indu, is kind of perched up there but dropping. We took a look at our NAS finance sector. It's also not doing too much. Biotechs have been relatively weak. Biotech's taking out new 90-day lows. So that's why I like to trade LABD, L-A-B-D. That's a instrument that goes up when the biotechs goes down. Here you can see it's up almost 4% yesterday. So the NASDAQ biotech sector was in the toilet yesterday, but shorting the biotechs has worked out great. It went from the base, 18 has been the key support resistance level historically in LABD. Now we broke out to new highs. Spectacular run all the way up to 25. Buy, buy, buy. Again, not a trade recommendation, but I'm going to buy this guy if he keeps going north of 26. That's how to short the biotech sector, right? Whatever you do, don't day trade cheap under $10 current pop and drop gap, crappy POS biotech stocks. That'll just get you in trouble. I'm shorting, right? I go short by going these. What else is going on with our other sectors? So biotech shorts is good. Insurance sector is holding its own. Typically, when markets sell off, you have things that don't have as much China exposure, given our current trade war with China. Fight. Whoosh, it's a fight. Who's going on? So we're seeing defensive plays going from out of momentum and tech like the FANG stocks and into value and other defensive sectors. We're seeing stocks like Micron. I called it short for my traders yesterday. Things that do have China exposure, like tech, like semiconductors. And look at the SOX, right? SOX was off over $1.60, 1.6% selling yesterday alone, right? So things that have China exposure from an active trader standpoint, obviously you don't want to buy. So that leaves us with consumer cyclicals, utilities, defensive plays, things like Johnson & Johnson, slow. For the investors out there, things that don't have much China exposure, the right way to go. But for active traders, we've got to be a little smarter than that. We've got to be on top of current immediate trends, whether it's the VIX popping or our biotech shorts racing up. LabD is the best of the inverse plays because it alone is up at a 90-day high. My other plays, like the semiconductor shorts, kind of like a second choice, second place from a sector standpoint. SOXS had a short semiconductors, right? With upside volatility huge in these instruments, and especially the fact that we're seeing an uptrend off the earlier lows. This is SOXS, the semiconductor short ETF. It'll especially be a good play if it breaks north of the 50 SMA, right? So huge profit potential out there in a variety of instruments. I did an ill-fated so far underwater losing trade in JDST yesterday. I bought it 16, I want to say 1620. Anyway, but I'm okay with it because it's still in an uptrend. But look at the upside potential. This is shorting gold, which is likely probably not a brilliant idea. But hey, we have a price that proves it wrong as the support right here, right near 11 or 12. I don't see any support of the candles confirming a bounce, so I'm more nervous about a bounce in JDST in my current position than I am in my TVIX, which I'm much larger share size in, because TVIX had a really nice, we can zoom in on this guy, you can see it had a really nice double bullish engulfing pattern, which, as I mentioned to my colleague Steve, I spotted that it's very rare. You don't see double bullish engulfings in an uptrend with large volume very often, but that's a buy signal. So see if you too can make a fortune in the stock market or lose your ass. Either way, you want to have a plan of attack that develops an intelligent approach. You're looking at a variety of charts. Let me know if any questions. Let me get up and going for questions here. Oh, good to hear, Mukesh, about, let's see, BW, hey, Barb, I think it's Barb, right? What's the difference between TVIX and UVXY? Well, you can kind of pick your poison. They all have, kind of zoom in on these guys. They're different percentages. The TVIX is the most volatile for the most experienced traders. UVXY has less. They're issued by different, like Credit Suisse is TVIX. We've got Direction and other issuers for other instruments out there. If we look at these guys, UVXY, where's VXX? I had slowed down trading VXX when it expired and changed into VXXB because that was kind of confusing. Kind of like when they changed the Qs from 3 Qs to 4 Qs back to 3 Qs. Anyway, we have different percentages, so that's a good question. When it comes to trading any of these instruments, the thing that I always pay attention to is who's the most green on the screen. Which of these has the biggest percent? And these are calculated percent change from open. I had a question from a trader yesterday saying, Ken, your percentages don't match mine. Why? It's critically important that, more so for intraday than swing trading. So if you're a day trader, make sure that your percentages all have compute change from open, because that sets everything at a 0% change basis at 9:30. And from a relative strength standpoint, the ones that are starting to break out first will show up as green earlier than if you're calculating from previous close. That's not nearly as useful. So make sure you have your percentages to calculate the change from open. Anyway, what you want to do as a trader is be like a market detective or a bloodhound. You really have to have a nose for where institutional volume, new institutional volume is coming in. One thing that it took me, I'll say over a decade to get over is the fact that historical chart patterns are nice, but that's only like 10% of it. What's more important is directional new volatility and the directional trend and volume that's manifesting itself in these charts to tell us, kind of like being Sherlock Holmes or the epic TV series Murdoch Mysteries, which I'm a huge fan of. Canadian, eh? Highly enthusiastically recommend Murdoch Mysteries. And John Wick 3 is a great movie too, recently. And Anna is a great movie by Luc Besson, a badass, super hot model assassin. If you're into action and all that, the two best action movies of the year are Anna, And number one is the John Wick 3, and then Anna, the two really good movies. But anyway, the point is, as a trader, we're out there also taking headshots at the market, and you're trying to figure out where the money's coming in to make a profitable trade. And there's a lot of signals and clues that get you on the right side of that if you know what to look for, right? So that's one thing we want to look at. Hey, Alex asking, how do I find stocks for trading daily the fastest way? Join my live room at www.tradingtheopen.com. That's where to find. There's a lot of free sites that show what's moving. FinViz is good. It's like the sales answer. The straight answer is, I'm always honest, right? FinViz, FINVIZ.com is really good. Stockcharts.com is good. Bigcharts.com is good. There's a lot of places out there where you can find what's hot for the day. The trick is knowing when to trade it, and more importantly, when to exit. Like I sold into the exit here in anticipation of the drop, then rebought my shares on the bounce later. I didn't know if I was going to get a Trump tweet and this thing would immediately go boom. Good news with China, and it starts to bounce. So anyway, I'm a huge fan of Trump, by the way. But the Trump tweet indicator, I should come up with something like that, right? We're in a market that's on a razor's edge, and all it takes is kind of like a feather to knock it over, barely push it, and the market's going to roll over or up with any news headline. Institutional traders are very sidelined and anxious now because there's not clarity of a good point that Kramer made is we're not using standard valuations. And I completely agree with the guy. He's a brilliant point that he's been making this past week about we have non-standard metrics like, investigations into privacy concerns or China trade war. All that stuff is difficult to relate, non-financial, but still materially important to the company's success, stuff that's going on out there to the traditional metrics like PE ratios and forward earnings growth and current profitability and other standard metrics that we use to evaluate stocks. Valuation, it's tough to get a valuation right now because there's so much random noise out there in the market. So what are we left with? What's the one thing that matters to us as traders beyond keeping small stops? What's the one and only thing that we care about? It's price action, baby. That's all we care about is the money. Show me the money. If it's going up, I'll buy it. If it goes back down, I'll sell it. If it goes back up, I'll buy it again. If it goes back down, I'll sell it again. If it goes up and I buy it and I get screwed and it goes back down, I'll take a small stop and sell it. Price action's all that matters. And that's all you can trust is don't trust anything except the money, the facts. Like Sergeant Joe Friday from Dragnet would say, just the facts, ma'am. And that's what we're caring about as traders is just show me the money. Where's increasing money flow? My thesis on this is that we've got a double bullish engulfing and we're in a current uptrend and we got a lot of economic headwinds. But, if I'm wrong in my current open positions, which I'll show you briefly here, I've got a wrap right now. I've only got a minute left. But these are my current positions, every single one of my positions in this account. And you can see I'm mostly bear bias. I've got 300 shares of TVIX. I got 100 of UVXYs. I got 150 of VXX, just to round things out. I'm underwater a little bit in a few of these like UWT, and a couple of speculative plays like MDR and JDST on their bounces. I play oil and gold. I'm short gold by being long dust and JDST, and also playing oil both directions with things like I'm in both arbitrage. I'm both long DWT and UWT, right? And they offset. My loss in UWT, I'm down $43 in UWT. That's offset almost exactly with a $44 gain in DWT. And then I'll scale into whichever one works out. As an active trader, you need to use position sizing and scaling and diversity. And you have to have an intelligent, focused, accurate approach to making the most out of our current market. So as you're looking for trade setups, make sure that you're doing a good, honest job of it and you're trying to figure out to the best of your ability, where's the money coming next? And you will only see that with price, right? Price and volume. That's all we care about. The two best cards of the deck, the ace of the deck is price and the king of the deck is volume. You combine those with the volatility approach that's unique and special to what I cover, and you should be in good shape. So anyway, take care, everyone. Appreciate it. Nah, thanks, Phil. So I'm glad I'm not afraid to share my political views. Not afraid. You can't be a trader in a, well, maybe if, don't get me started, but the Democrats want to pass a financial transaction tax. Uh, just think of how much worse we'd be off if, say, Hillary Clinton had won the presidency. Yeah, that's just a nightmare. Or if someone like Elizabeth Warren wins the presidency. Just literally shitting bricks. You don't, so maybe not literally, but the point is, as an active trader, you want to support the political party that's on the side of us as traders. If the Democrats do pass a financial transaction tax, we cannot day trade anymore, and we can't swing trade actively either. So if you are a Democrat, I hope that you will work positively from within your party to try and tell them, whatever you do, don't pass a financial transaction tax. Uh, or if you want, you can be Republican and vote Republican, and it's a non-issue. So anyway, as a trader, do what's in your best interest, is what I'm saying. Now we're trying to take a look at which charts make sense. If you're looking at which volatile triggers in our current markets, if you are looking for speculative longs, you have to have consistency and volatility and charts that have nice big ranges. And, there's always going to be a shining star out there in the market despite it selling off, because that particular company is doing spectacularly well. So for that reason, you want to isolate and cherry pick out the best charts for long plays. And for swing trades, like you can see, I'm almost all cash as far as long positions, other than the bear inverse ETFs, because that I could be wrong. Maybe we'll get a headline of, after the October 10th China meeting, there might be a resolution to trade. I think that China's just going to wait out the presidency and maybe do some surface level. Mark my words, this is what will happen. If any progress is made, it'll be superficial and inconsequential and not real. It'll just be for public relations purposes. If we see any kind of progress in the China trade war, it's just going to be tentative and inconsequential at best. Meaningful change in trade relations with China would only occur during a second Trump presidency after the November elections next year. So China's waiting, as they are. China always has a long view, right? They always have a very long time horizon. They're the number one in the world for having, like a 50-year business plan or 100-year business plan. So we're likely not to see any economic headwinds get alleviated from the China trade wars until after November. So with all that uncertainty out there in the markets, we're likely to see a drop in equities. So that's how I'm playing it. All right, Mukesh, I agree. All right, Jim, absolutely. Asking the question, do I use the average true range in instrument selection? Yeah, the way that I do it is I use this pattern. We have a small ATR. Look at the average true. If you're using, I don't use the ATR indicator because I just visually, I'm an expert trader. I just look at the height of the candles, and from that is derived the ATR. If you're an experienced trader, you don't need squiggly line indicators. All you need is price action. What I look for is an increase in ATR, like right here, this delta. See the flat average true range here? And the flat melted candles, we get this pattern of a small followed by a large whole real body candle, and that's often a really good volatility signal that things are about ready to explode to the upside, as this did from 11 to just under 20. And as I teach so often, which is so correct, you sell the nines, right? You never buy anything with a 9. That's your exit target. As I mentioned in my stocks and commodities article, one of over 36 I think I've written, you buy above a decade value, you sell right under the nearest decade value. So if you get in at 10, 50, 11, 12, whatever, somewhere right above the decade value, right above this 100 SMA, and this is, I don't know if that's a copper cross or something, a 50 SMA crossing 100 SMA. A golden cross would be if the 50 crossed the 200. But anyway, a nice bullish confirmation uptrend. It broke out above the 10. That was a buy signal. Now we'd be selling it because it hit the 19 target right under the 20 decade value, and we rebuy if it gets back up at new highs. So you kind of cycle in and out of your trades to make the most money in your entries and exits potentially. So that's the intelligence and the level that you need to be at as a trader. And if you're not there yet, don't worry. I mean, I spend a fortune on consulting from people that specialize and spend their life on something. Like I hire some of the world's top tenor saxophone players to teach me how to be a better horn player is one of my hobbies. because I don't have the time to spend 18 hours a day learning all that stuff. So I hire and outsource the skills and the tips and the inside tricks of the trade that I never would figure out on my own. And it's true. Somebody spends their life doing something and they're fully immersed, as I've been for over 2 decades in trading. I've got a lot of expertise, as do a lot of my colleagues who've been around for a long time. Learn from those of us who've got the expertise and the knowledge and the skills, and hopefully you'll make a go of this and make it work. So, all right, yeah, Pat's saying TVIX is going up. I sell and buy in again to lock in those profits, right? Yeah, TVIX is always a buy the bounce. That's why I sold 100 out of my 300 TVIXs on the drop down in case it was going to be a big drop down. It wasn't. It was just a modest drop. So, sold at the first sign of a pullback, then bought a bit lower to get a little price improvement on the bounce. But big picture, TVIX, I want to always maintain a minimum 300 shares in the position until we break back over the 20. And once we break north of 2021, where I first started swing trading it, I'll scale in substantially into it and the other VIX ETNs. I got to run, gang. We've got our Swing Scans episode coming up in a few minutes. Wanted to wish you the best for successful trading next week.